Hi everybody, welcome to the video. Today we are going to deep dive in the world of synthetic futures. We're gonna talk about synthetic futures. We're gonna talk about how we can get the margin benefit when you trade it, where you should not trade it. If you've been trading futures from quite some time, you're gonna get some good ideas from this video. Before we start, disclaimer, any strategy, any trading technique involves risk to capital. Point number one is, why should we even do synthetic future? What is the benefit of it? Now, a lot of viewers of this channel, they do leaps option strategy. They absolutely like it. They like to do it. But the future, you can only trade for current month or next month or next to next month. But can we create a synthetic future where we take an advantage? Also, a lot of audience, they don't have a lot of capital in their trading account. And when you long or short future, then the MTM, that means every day-to-day MTM sims, get deducted from your trading account, right? I'm sure you like to know how you can make it better without compromising on the strength which you have when you trade synthetic. And once I explain you what exactly synthetic future, we're gonna talk about the margin benefit. Plus, we also look to get a margin benefit. How is it even possible? Well, let's see if it's possible or not in next few minutes. But first, I'm going to cover what exactly is synthetic future and how to create it. I'm going to clear out a lot of confusion in next few minutes. So here we are on an option simulator. Even if you trade Indian markets, you trade US markets, you trade any other markets. Now here, 24/700 is at the money. So if we have to long the future, okay, what we're going to do is we will simply long the call and the same strike, same series, same quantity. We look to short the put. And as soon as we do it, we long the call, we short the put at the money. This becomes a synthetic long futures. This is a synthetic future. Let's compare it with the payoff of the future, how that looks. Now here, if we just simply long the future, it's going to tell you that if market go up, then it's going to be green. If market go down, it's going to be red. We are mimicking the exact same movement by playing the future, not as a long future, but as longing the call and shorting the put. If we have to short the future, then what do? We do exact opposite of it. That means in this situation, we're gonna short the call and we're gonna long the put. So what it becomes a sort of a short future trade for us. Now, the most important point, which we are going to use very effectively, that is to get the margin benefit, which I'm going to tell you later. Suppose if you do not, short and long the same strike. Instead, what we can do is we can go slightly more, a different strike. Maybe we can select a round number, maybe 25,000 we can select, and we look to short it. At the same time, we have to long it because that is a rule of synthetic. So we short it and we long it, and what do we see? We get the same payoff. You short any strike at the money, in the money, out of the money. Make sure that you're shorting and longing the same strike, same quantity, and same series. That becomes a synthetic future. Now that you know how to create a synthetic future, let's discuss some more points how to get the margin benefit. Now, people who trade into options, they have different option strategies at one point in time, right? Maybe simultaneously, a person is running a short straddle or a short strangle, or maybe iron fly, or maybe Batman, ratio spread. There's so many strategies. So maximum traders have a lot of strategies running at one point in time. Now, when we can trade synthetic future, we have the ability to go in the money, out of the money, or at the money. Like I showed you, we proved that point. Let's go a little more deeper on this. Now, synthetic future require approximately same margin as the future because it's mimicking the same price. Now, imagine in your other strategy, if you have suppose shorted a 25,100 put in that situation, or if we reverse it, for example, right? If we reverse it, suppose if you have you are trading a short strangle in your demat account and you have another strategy of short strangle. Now in that short strangle, you have shorted a 25,100 call. As soon as you buy this call, what do you think will happen to your margins? Because a broker don't see these two positions in isolation. They see all your positions all together and then they calculate the margin. Tell me in the comment section if this is ringing any bell. Now, in that situation, this call will give you some kind of against the naked call which you have. Point number one, very important point. The whole idea is to get some kind of a margin benefit. Try to trade the future, but a good alternative of synthetic future. Very good and important point. This one is pretty strong. Point number two is caution when using it in stocks. Now, I'm going to tell you about the stocks as well. Before that, I want to tell you one more point that, like for the leaps, now suppose if you have to trade March 26, suppose you're bullish on the market or you're bearish on the market. Now, the only way remains is probably you can long or short the current month or the next or the next. But when you create synthetic in March, all you got to do is the same strike, which is liquid. You can probably long the put, short the call, that becomes a synthetic. Point number three, which is even more strong, that is MTM swings, right? When you trade options, you have a little more space for the settlement. Versus when you trade future, if future give you a loss for suppose 10,000, you got to have that 10,000 in your account at that time. Otherwise, a lot of broker square off your order. Now, caution when using it in stocks. It's important to know when to do this. What is the advantage of it? Also, it's important to know what is the weakness of it. This is not one of those channels where we only gonna talk about the good things. No, we're gonna talk about the bad things as well, which is in stocks. Now, please do not replicate it. It's not recommended in stocks because stock has liquidity issue. Now, suppose that you long the stock and stock actually go up, but you have long the call and you shorted the put, right? Normal synthetic, but the call which you long has become in the money now because the stock has gone up. Now, all of us know in the money options have, what do they have? They have low liquidity. So in practical, the profit is gonna be very less because of liquidity issue, and stock have those issues, especially illiquid stocks. Now, I know most of you must be thinking in terms of adjustments, right? When you trade future, there are so many strategies which combine with the future. So when you do synthetic needs to be treated like a future or not. Let me tell you again, these two positions to be treated as one. They are not two units. This is one unit itself. Important point. So when we do any kind of adjustments, suppose you are long in the future and you want to buy a put, you want to hedge it, one can definitely do it, but has to be considered that both the legs should not be touched because both the legs are component of a future trade only. Very important point. Now, next time when you trade future and you have a lot of option strategies running at one time, maybe you want to trade leaps, maybe you have an MTM, you are falling a little short in the margin and you are not allowed to short or long future. In the past, I've made some really good videos about how to adjust your trades if your trade gets stuck, how to take advantage of adverse situation when you trade into the markets. I'm sure you must have learned a lot. Thanks for watching and I wish you all the very best. Take care. Bye-bye.